Hello and welcome back to Duca's Copy TV. Now, exit strategies, they're always in your mind when you invest, and if they're not, well, they should be. But some work better than others in different situations. Well, joining me in the studio is Gustavo Montero, who is the partner at GAM Consulting Group. Gustavo, welcome to the studio.
Thank you very much, Thomas.
First off, when should I float and when should I sell? A simple question maybe to you, but in its basics, when should I float, when should I sell?
The question is not that simple, but just some parameters of when. Obviously, when markets are hot, bullish, and when market sentiment is very high, that's the best time you can float now. We're not living those kinds of times today, but that's the time. But also there's some technicals. For instance, you want to float when your company has a revenue range above $30 million, or maybe when your market value is above $20 million. Those are figures the markets really like. But also, Thomas, when your company can afford the cost of a flotation, is often in the hundreds of thousands of dollars and sometimes in the millions of dollars. But also when your company can cope with regulations. There's going to be a tremendous amount of regulations coming in when you float, and you need to be able to cope with that. There's another issue which is important. There are flotations of a smaller size than 20 million or 30 million. There are different markets where you can come up with those type of flotations. So it's not only for very big companies, but it all depends on the timing and what your strategy for your exit is.
Okay, if we were to look at flotations, for instance, and we were to look at big companies, early in the year, you may remember we saw two IPOs of pretty well-known and vast companies, Facebook and Manchester United. Both IPOs went generally well, but not perhaps as good as expected. What are the major benefits and risks with slow sell-offs, IPOs, and quicker sell-offs, which were the trade sales, for larger companies such as Manchester United and Facebook?
Well, I guess you're referring to the fact that Facebook price went for $38 at an opening, and today is around $28, so they've lost 30% of their value. When you come and compare benefits and risk of IPO vis-a-vis trade sales, we can say the following things. The IPO, in terms of benefits, obviously the valuation often is around 20% higher than a trade sale. You will have a lot of public awareness and prestige by doing that. But more than that, when you do an IPO, there are normally new business developments and alliances that come as part of that IPO. In terms of the risks, obviously you have the market uncertainty. You look at what happened with those two IPOs. You have the market regulations that will come on you as a company. There is also a significant amount of time involved by your management team when you go IPO. So you may have to keep your eye off the ball. You cannot run your business as well as before. And also there is a public exposure. Your company now is exposed to the public, and you have to do things very well. When it comes to trade sales, perhaps the benefits are you're selling your company outright. You're selling it at once, not like in an IPO where you're selling part of the company. If you're a very good negotiator, maybe your pricing on a trade sale could be almost as good as an IPO. We're talking about 20% difference, but if your negotiation is very, very good, your pricing could be perhaps the same. And also, you don't have the IPO costs, which is the problem to some companies. In terms of the risks, okay, you may be required to stay with the company for a couple of years. You want to take off and say, take your money, great, you sold it. No, they will tell you, you stay for 2 years as a manager of the company, because you're going to have to pass on contacts, business, etc., etc. Also, as I said before, maybe you're undervalued when you have a trade sale vis-a-vis the IPO. 20% is the number we use, could be more or less. But there is another point. When you do a trade sale, sometimes you're backed by a VC company. And when that's the case, the VC company will take over the negotiation and they will negotiate for you. You will lose really the control of your trade sale.
Does age ever play a part? Because, I mean, if we look at, say, Mark Zuckerberg, we look at Facebook, he's a young lad. Does age play a role in that? I mean, it was his own company, he's young, he may not necessarily wanted to have given it away straight away as such. Does it play a part?
Yeah, it's a personal opinion. I think that it does play a role. When it is a very young person selling a company, there's a lot more emotional involvement. Is his or her own baby, created it, doesn't want to give it away. He may not go for a trade sale, but he may go for an IPO where he or she may keep part of the company going forward. And if he has a good shareholder agreement, he may be able even to run it with a minority of the shares. When the person is older, perhaps the only thing that the person wants is just to sell the company and go home with the money, and that the trade sale would be the best option. Yes, there may be a difference.
It's interesting that. I mean, is there anything to be learned from seeing high-valued companies prior to listing fail to move markets with sentiment?
Lots to learn. First of all, that public markets may not always be the right answer to an exit strategy. This is a very important point. Now, also, when companies are going public, they have to have a very tight coordination with the underwriter. The underwriter is the bank that helps them to go public. When information comes to the public in a disparate way, not in an even way, you could have a situation like what happened to Facebook with the underwriter. There were different kinds of information coming to the market. People didn't know what to think. But also, it's important to understand that market sentiment may be different to the expectations of the companies are. Mm-hmm. And it's very difficult to judge, but it is a situation that one should be very aware of. But the last point, perhaps, which is very important, often companies forget, is that the stock price is like a commodity. It's a supply and demand type of situation. So if you come up to the public markets on an IPO, you have to keep marketing your shares. Many companies come into the markets and they forget about the fact that they went public, and then they have shares trading out there. Mm-hmm. They have to keep marketing, showing information, etc. Hence the importance of investor relations, which communicates with the investors, providing that information.
Okay. Gustavo, well, thank you for that. I mean, this is a topic I think we could probably talk for a lot longer. Just before we leave, we've got our Duke's Copy question, which if you're not familiar with, but I think you are, because I think you came on before and you selected gold in the last one. We've got a selection up here, the same selection as usual. It's the asset classes. We've got real estate, equity, bonds, gold, cash, oil. Are you going to choose gold again?
Yeah, I'll stay with gold.
So with the $1 million US, you put it in gold?
I'll put it in gold. I believe that you have to protect yourself. The way to protect yourself is gold. In my opinion, the price of gold will keep going up. So if you have $1 million, put it in gold today.
Mm-hmm. Not equity?
Not equity.
Okay, just checking, because we've had a few people select equity on here. Gustavo, thank you very much for coming in once again. It's great to see you. Thank you.
Thank you very much.
That's all we've got time for on Duke's Copy TV right now. Stay with us though throughout the week. We'll continue to bring you further interviews and updates. But from now and from everyone here at Duke's Copy TV, goodbye.